What's up, Outliers? Happy Monday. Time for a little impromptu stock market update. We have no Pro Plus live stream, well, I guess, workshop today. That is next Monday. So figured we would use today to take a look at the markets together quickly, see if anything sticks out to us. And there are a few things, as usual, that I find worth a discussion. The first one actually is in energy. Right now, in energy, we're seeing a pretty big difference between what is performing well and what is slowing down. A lot of that has to do with power, specifically nuclear power. Nuclear power is continuing to do pretty well from a back-end perspective, and I think a lot of that has to do with just a more favorable leadership in the White House that's, governing policy decisions and whatnot. That continues to be pretty interesting. Another thing worth highlighting is actually from here. For those that don't know, SIBO provides actually a pretty cool report, and the woman that writes this, she's awesome. I've spoken with her a couple times, and this gives a lot of fun detail around the market in general. And I want to talk about this plot here specifically, and it's really this bullet point. This says implied volatilities were mostly range bound last week despite rising geopolitical risk. For those that were on the stream yesterday, we literally talked about this exact thing, saying that vol continues to seem a little bit cheap relative to what's going on in the world today. That's here. Equity, rates, credit, and foreign exchange volatilities all ended the week near one-year lows. Oil was the only notable new mover, with 1 month implied vol jumping up over 8 vol points to 36.8%, which is the 70th percentile high. So again, that's effectively an implied volatility percentile. You guys are familiar with that metric. As we highlighted last week, option market positioning has become increasingly bullish in oil, with outsized demand for upside calls driven in inversion in oil skew, driving an inversion in oil skew, sorry. This is evident in both options on commodity as well as USO, despite the threat of more supply coming online from Venezuela, which is a really key part to this equation. Traders appear more focused on the near-term risk of potential supply disruptions stemming from the Iran unrest. This I am slightly dubious of, personally. I think that the market itself is pretty good at sifting out nuance. And I believe that in general, the market has a fair idea of how they're perceiving and pricing these two different factors. The total supply disruption from Iran is not insignificant, but the total supply from Venezuela also is a little more insignificant, but not totally insignificant either. And they're kind of like competing ends of that spectrum. The way to think about these kinds of catalysts is that there is a near-term and long-term opportunity. The near-term is the dislocation between what you might perceive requisite vol for commodities, crude, things like that, against what you think the longer-term impact might be to the companies themselves. Specifically, big oil companies, Chevron, ExxonMobil, and stuff like that. Even with Trump's escalating attacks on the Fed over the weekend, which I think there was, recently charges filed? Is that correct? Somebody, if you can, look that up really quick and let me know exactly what it is. But I think that there is some sort of movement against the Fed, and I think it had something to do with some sort of office redesign or some shit like that. I remember coming across it. I didn't spend a lot of time reading because I don't actually care, but I did find that interesting, whatever that was. Somebody will throw it in the chat that has a chance to look it up. Here it goes on to saying cross-asset vols appear fairly tame. Investors weigh the risk of Fed independence, which, again, I'm not so sure that that's like some sort of massive risk here. I think there absolutely is a function of knowing Powell and Trump don't get along, but I don't think that Trump is super interested in absconding Fed independence. I think Fed independence will continue to remain pretty strong. VIX is up, and this is from earlier today, so I don't really care about that. This is looking at the 1 month vol surface, and this is looking across a few different dates about a week apart. And you can see that most of them are trickling up. And then at the high end of the tail, it's coming down. Oh, hold on one second. Let me grab that. What is this thing? Oh, yeah, I forgot about this. I totally forgot about this tool. Man, this has been a while. In case you didn't know, there's a super cool tool that you can use that breaks down VIX across various durations and stuff. I totally forgot about this. That thing's pretty sweet. Zoom back in here. Yeah, so risk premiums are still fat. I mean, look at this. 1 month vol effectively trended over 1 month realized essentially from May on, ever since we went through that initial inversion in April. Here we can see, oh, this is pretty long-term, 10-year Z-scores. That's curious. That's interesting. To no big surprise, gold is trading at a massive, massive upside Z-score right now. It's like 2 standard deviations plus to the upside, which I don't think that I don't think that surprises anybody. Tom says DOJ has sent grand jury subpoenas. Thank you, Tom. Has sent grand jury subpoenas to the Federal Reserve targeting Powell regarding his testimony on building renovations. That's what it was. Thank you. I appreciate it. Keeping everything on the up and up. Cross asset. Yeah, I mean, nothing here is jumping out at me. I don't care about those. Don't really care that much about this. This is simply saying that stuff like USO is running actually quite rich relative, because even though their realized vol is pretty high, it's at like 30 or so, it's still leaning fat at like 34 on implied. So there's still edge there. This opens a really important question. If in USO, a trader saw this and the trader chose to short a straddle in order to capture this, what do you guys think about that? We see USO has fairly rich implied vol relative to realized. Not super, but relatively. If a trader saw that and they said, I want to sell a straddle in there, what do you guys think about that? What would stick out to you about that decision? Think about it. Tom says sell straddle, face ripped off. Why? Why would their face get ripped off if 1 month implied volatility is rich relative to 1 month realized? Why would they get hurt? Because IVP is low historically. Does that actually matter? If IVP is low in USO, but IV is still trending rich compared to RV, what do we think? Let's take a look at USO really quick. Let's go to, which IVP, by the way, is actually pretty damn high. It's like 80 percentile. Ethan says vol could spike. Past RV doesn't equal future RV. So two things here. The first one is if vol does spike, does that necessarily unwind the trade or the trade idea? With respect to past RV doesn't equal future RV, that we also know. But what's the nuance around that? Because we also know that volatility clusters. What that tells us is that when we're analyzing stuff like volatility, we know, for example, this period. This is a good example in here. Through this duration, volatility was kind of doing whatever, right? 30-day vol is probably generally static. If we blow it out, you can see it down here. Then, over at some point during this, we get volatility increases, which you can see here, and you can see that reflected right here with the lines trickling up. Volatility goes up. But then price comes back into range, and if a trader was trading, 1 month or 45-day options over this duration, they're completely fine. Even though volatility might have upticked during the duration of their trade, they might still be completely fine. What do we think there? The point I'm making is that even though past RV or really nothing predicts purely future, there certainly is a relationship. And the broader point here is that in something like USO, if you see something like this as the starting point for a trade, you're not actually doing too bad. You're not doing too bad. Like, this is a fair beginning point. The risk to this trade is some that the group has noted. One of them is if vol does spike, that would be a temporarily, but albeit still not good scenario. The other event that could occur is volatility itself might not blow out, but the market could trend. And then if the market trends, that's a different issue. Because when we're talking about volatility in this context, clear this out. Volatility is a deviation from a mean. If we have something that's moving a lot, but is range bound, this might have really high volatility, but its total price range is whatever relative to this volatility. But you can have something where volatility starts high like this, but then it stops these big oscillations, and then it slowly starts to trend in one direction like this. This is a scenario where volatility might actually be going down, but this is actually actively hurting your trade unless you do something specific. And again, it goes back to the original question. What if a trader saw this and they sold a straddle to take advantage of it? The cliff notes is that this could be fine. It does depend on path, and it also depends on the management. For example, if this same scenario occurred that we just listed here, but the trader was hedging their deltas, not necessarily with the underlying. It could be by rebalancing the straddle, whatever they want to do. Realistically, it doesn't actually matter. But if over this duration, IV remains greater than RV, if you simply sell a straddle, you might lose money, even though implied volatility ultimately was greater than realized volatility over that duration. The reason why you still might lose money anyways is because as you start with your straddle, which is negative 50 deltas from the call side plus 50 deltas from the put side, as the underlying is going up like this, what's happening is your puts are moving further from the money. So now they might be a 40 delta, and your calls are moving further in the money. So now they're negative 60 deltas. So where we started flat in terms of our total deltas, we are no longer flat. We're short 60, long 40. Net, we're now short 20. This trade is now taking a directional tilt. You are not actually trading implied vol relative to realized vol anymore. That might have been the original idea, but if we sell the straddle and just sell the straddle, your trade can start taking on a different shape. Now, there's something to be said about trading a snapshot of vol, and then in that case, this would just be wrong. This would, from point A to point B, trading the entry to the exit, you can do that, but this would effectively just lose money. The thing that I'm trying to make sure we're aware of when we look at stuff like this is to always remember that there's second and third levels to when you're deriving your trade ideas. There's nothing wrong with tinkering with superficial or high level ideas to start, but eventually and over time, you absolutely have to pivot and appreciate a little bit more of the nuance so that you can actually address and trade the things that you want to actually trade. Because if this straddle seller comes in, sells the straddle because they see this, they're starting off saying to themselves, well, I'm going to trade implied vol relative to realized vol, which is fine. But depending on what the underlying does and depending on what they do, over the life cycle of that trade, they might not actually do that. It depends on the path. And this is why thinking through your trades is important so that you can at least get good feedback loops and make sure that you're trading the stuff that you want to trade. Because what becomes really nefarious is when you think you're trading vol, but really you're trading delta, and then you think that vol trading doesn't work. And now you're off in a completely incorrect path from the incorrect understanding of the feedback loop. Be careful with that. That's all. Ethan says, could sell puts or calls based on your theory of direction, given premiums are overvalued. I don't fully follow you. What do you mean? What do you mean there? Could sell puts or calls based on your theory of direction. I'm not totally following. The part that you're saying of based on direction is absolutely correct. What I pull from that part of the statement is this. If we have an underlying, and let's say that this is price, let's say that this is its volatility. If I sell a put, Ethan says have a direction bias. Oh yeah, definitely. That funny enough, that's actually exactly what I'm going to show you. If I sell a put right here, actually, no, let's make it line up better. If I sell a put right here, where implied volatility is very high, relative, let's say that this is the 90th percentile. If I sell a put here and implied volatility goes from 30% to 10%, I lose 20 vols. That will be unfortunate. However, if the underlying, instead of doing this dip in rally, let's say that the underlying starts a breakout and does this. This trade unequivocally will make money. Completely devoid, completely separate of this. It'll absolutely make money, no matter what. What I'm highlighting is that when a trader is trading short calls or short puts, their dominant profit mechanism is still delta. Their prominent profit mechanism is not implied volatility at all. And it's not theta. That's not the primary profit mechanism for either of those. Those are absolutely impacts to P&L. They absolutely have a piece of the equation, but the dominant force is delta. So what I mean by that is, let's flip this on its head. And I realize that this is vol going down. So instead of a short put, let's say that this was a long call. That's a better example, because this long call will be hurt if vol goes down by 20 points, right? We're long Vega. But as long as price goes up and it goes up enough to overcome the Vega impact, this still will outperform, meaning it still will overcome this and then be profitable here. When we're trading single options by themselves with no additional management, we're not in any way isolating this at all. We're primarily trading direction. And this is an important concept because a lot of times people will sell an option and they'll say to themselves like, oh, like I don't have a directional bias. I don't really know which way it's going to go. So I'm going to sell a put so I have a little bit of room if I'm wrong, and then I'll make money if I'm right. But that's the entire wrong way to approach options. That promotes and allows a laziness in analysis. It allows people to effectively skip the entire part of the process where we have to do the hard stuff, which is analyze something, come up with a hypothesis. And the reason why it feels so good to not do that is now you don't have to confront yourself if you're wrong. For the people that really go back and circle back to the concept of, oh, I don't have a directional hypothesis, I guarantee you those are the very same people that have issues with being wrong. Guarantee it. The reason is because there's no benefit to not having a directional hypothesis. It doesn't help you at all. If anything, it negatively impacts you. But a lot of those people, they don't want to stake their name or, even to themselves. They want to stake an opinion because then we now have to confront ourselves if we're wrong. But that's just not how trading works. Even when you're selling premium and you have a little bit of a gap, it doesn't actually matter. You're still trading directionally all the same. The only way that you're really isolating this effect here is if you're actually scrubbing off your deltas. So what that means is if we start with that short straddle, we have our negative 50 deltas from the calls, positive 50 from the short puts, and the underlying starts to trickle up. Our puts lose some deltas, so now they're plus 45. Our calls gain some deltas, so now they're negative 55. It won't be perfect in a vacuum like this. But now our net started at 0. Now our net is negative 10. Depending on the size of the trade, your delta bands and stuff like that, you have a bunch of choices. You can either rebalance this position. So what that means is whatever you sold to open it for here, you buy to close it here, and then you sell to open a new one that gets you back to 50-50. That's one approach. Another approach, is by buying to 10 shares. By buy to open 10 shares, this is now flattened. What's the downside of this? If I just buy these 10 shares, what's likely to happen pretty soon? What do you guys think? I got to open the door for Thor. Thor disappeared, but I left the door open for him. No guesses? The issue here is gamma. The gamma of the position now changed. In the beginning, your gamma will be relatively flat here. Not purely, but relatively. So here we have our delta, here we have our gamma. Here, if we use shares, which are delta 1, that doesn't adjust our gamma at all. And now our gamma will have tilted in some direction, depending on what the options chain looks like. So then what that means is as the underlying moves, I'm going to be offsides, but even faster now. Before I was offsides after a large enough move happens, which decouples the gamma opposition enough, that starts to compound. But if I do nothing about gamma, just leave that as is, that means as soon as it moves by one more point, I'm going to be off a bit more this time. And that issue compounds as we get closer to expiration and as we hang around the money, which, fun fact, short straddles are right around the money. Your gamma is going to start to move pretty heavily. In a vacuum, as this goes further in the money, your gamma will decrease on this part of the trade, and then your gamma will increase on this part of the trade, again, in a pure vacuum. There's a lot of nuance to this. It absolutely can be inverse. It could still be the same, depending on the size of the move, the duration, all that stuff. That's the nature of options. There's a lot of shit that goes into this. But the main point is that if you use the Delta 1 product, you can do that, but you now have another problem. You have to do something with those gammas. And the way that you can manage your gamma is either by adjusting this position itself or adding new options to the position that get rid of that, but now you have to readjust your deltas. That's what goes into actually isolating this drop here. Because without getting rid of this delta exposure, you now have a directional exposure, no matter what. Which is exactly why this style of trading is profitable, but it's difficult. And it's a lot more difficult than people think. So when people come into something saying like, oh, implied volatility is high, I should sell a put for volatility mean reversion, they're really doing something that they have no fucking idea what is actually going on under the hood. And it sets them up for a bumpy ride. In this kind of scenario, you would be way better off just simply saying to yourself, I think the thing is going to go up. I don't necessarily think it's going to go up a lot. So rather than buying options, I'll sell options. And then if it goes up a lot, you have an opportunity cost missed, meaning you could have made more, but you still made money. High class problem. That should be feedback for the strategy and to make an adjustment to how you're analyzing stuff. Because for example, if you're selling a bunch of short puts and you notice the things that you trade short puts in are going up a lot, you're leaving a ton of money on the table, a ton of money on the table. And it's because of exactly what happens with the short puts. As the underlying continues to go up, you're going to lose your deltas. So even if you start at a 40 delta, even at a 40 delta, underlying goes up by $1, you see 40 cents. You miss 60% of that move. Goes up another $1, now your delta's at 30. Underlying appreciates by 70% more, and so on. You don't want to miss out on all of that, which is all to say, using these to generate ideas is actually smart. It's a good way to base something. And there's nothing wrong with taking a time series bound estimation or bet on volatility. You just have to understand what you're doing and accept it for what it is. Because if you can do that, then you can modify and adjust things to get it on target where you want it. If you don't do that, then you have this system of really broken feedback loops, and you can't really make a good decision that way. It's impossible. Zaddy says, do puts cost same like shares? If you buy a put, you're going to have to put up money. But the good part about buying any option is that there's leverage. So it's not going to cost the same amount of money as shares. So for example, in USO, if I wanted to buy shares of USO, right now it's at 71.23. So I need to put up $7,123 in order to get 100 shares. If I wanted to get the equivalent of 100 shares, I can buy 2 of these 74 calls out here because they're a 50 delta. 50 delta at the beginning tells us that this thing is effectively going to give me the same directional exposure as being long 50 shares. So if I get 2 of them, I'm now effectively long 100 shares with the ability to be up to 200 shares because there's 2 contracts. To put this position on, I'm going to pay, let's call it $450. It's a little bit more, but let's just call it fine, $455. We'll get in at the mid, or $460, something like that. So I'm going to pay $460 times 2. You can see the beautiful part there is way cheaper than me buying shares. Way cheaper. But there's now a lot of other stuff going on. As I hold this thing each day, I'm going to lose 3 pennies off of this. That's going to accelerate as I get closer into expiration if it stays out of the money. So we start adding a lot of other factors, really, that, again, they're not inherently bad, but they catch a lot of traders off guard, and then they lose money because they don't understand them. And they're not sure why they're losing money. They can't actually troubleshoot it because they literally don't know what to look at. And yeah, that's the knowledge gap, right? That's the part that takes some time here. Reese says, I think some people think it sounds smart to not try and predict direction. That's exactly correct. You are 100% correct. It's like a lot of the other weird things in trading where it sounds good, but it's actually as wrong as it gets. One of the other examples of this is when people say things like, oh, you know, when they're analyzing a trade that's gone wrong, and they say something like, oh, I was too greedy. I was too greedy. It sounds like self-aware. It sounds like you're being tough on yourself. But the funny part is it's actually really superficial. That's like one step in. The reality is, for most people that are being greedy, in my opinion, they simply don't have a fucking plan. Because if you have a plan and you're doing something that you know works well, you're not greedy anymore. You're probably pretty fucking content to trade the thing that you know is going to give you a 30% return in a year. Now, the greed tends to come in when it's a new trader that doesn't fully understand the landscape. And, you know, they follow that Captain Condor playbook where, you know, just trading 5 minutes a day that you're going to get fast, easy money. And yeah, you can see how that works out. So yeah, people, that's one of the, again, I call them trap tasks, but that's one of the trap functions of trading is you can do things that seem smart, that seem like the right thing, but if you do them incorrectly, they're actually extremely damaging. And that is a fantastic example of one of them, Reese, for sure. Ethan says, long options having delta that move in their favor based on direction is why I love running diagonals so much over using shares. Yeah, and it's a really good point, right? What Ethan is talking about is a really important function of options. And again, it's not all that glitters is gold. There's a trade-off to it. But to his point, if you're good at predicting direction, this is actually a good thing. Because let's say, whoa, what the fuck is that? I don't even know what I clicked. Let's say that you buy these calls, right? These 74 strike 50 delta calls. You get them, you get your 50 deltas. We'll just do a one lot for now because it doesn't matter. If the underlying goes up, let's say that we increase by 1 point. We can figure out what our new delta is going to be by looking at our gamma, which is 0.03. So our delta is going to go from 0.50 to 0.503. You're going to gain 0.53, my bad. 0.53. You're going to gain 3 deltas here. So what happened as the underlying moved 1 point, here you made 50 cents, the underlying made $1. Now it goes in your favor. Now if the underlying goes up again, underlying makes $1, but now you make 53 cents and so on. This is the benefit. The other good part about this is that if you're wrong, long options have a built-in break. It's literally just the inverse of this. If the underlying goes down by a point, in your scenario, you only lose 50 cents, but now your deltas become 47. So then if the underlying goes down another 1 point, you only lose 47 cents versus the 50 cents from before. What's the trade-off there? Well, if it starts to go back up, it's going to be a little bit slower for you. Because as it starts to go back up, now it goes up, you make 47 cents, but the underlying made $1. And this is why understanding options is so important, because you can navigate all of this. None of this is that difficult to navigate, but you just have to understand what the thing is that you're trading and how it behaves so that then you can navigate it. Otherwise, an easy way to navigate it. The underlying's going down, and let's say that you get stopped out here. So here you pare down your position, you take it down, whatever, and then it starts going back up, so then you get back in here. But when you get back in here, instead of coming in at a 50 delta, if you have some sort of strong directional conviction based on your process, your system, whatever, maybe you come in at a 65 delta. So then you can compensate for that prior loss from poor timing with good timing. Now, what's the downside? If you're wrong again, now you lose more. And this is exactly why there's no savior in options. It has everything to do with your profit mechanisms and the indicators that you're using to identify those profit mechanisms, and then your ability to trade around those. There is absolutely zero magic in options. Options simply amplify things. You have to have the underlying bits together. And it looked like before Lauren is talking about Rocket Lab. So let's take a quick look at Rocket Lab. Oh, yeah. Oh, yeah. Do I have a position on in here? I do. So full disclosure, I do have a position on in here. Yeah, I mean, it looks good. Recent news. Hegseth visited Rocket Lab headquarters as part of his Arsenal of Freedom tour. During the visit, Hegseth positioned Rocket Lab as a cornerstone of the nation's modern defense industrial base, which is good. Emphasize that the future theater of battle will be won or lost in orbit. Yeah, that's an interesting way to look at it. Hegseth spoke to a group of employees about the shift in Pentagon procurement. He called Rocket Lab the foundation of the defense industrial base. Secretary's most striking comments focused on geopolitical weight of the company's work. Yeah. I agree with this. Rocket Lab secured a massive $816 million Pentagon contract to produce 18 satellites designed to detect and track the most modern threats. Company has evolved into a sophisticated defense prime contractor, is now competing directly with Lockheed, Northrop. That's exactly, from a fundamental lens, it's one of the reasons why I like this company. Is it's small enough at this point that it is able to grow rapidly. It can grow way faster than stuff like Lockheed Martin, Raytheon, Northrop. Those are big companies. Those are huge companies. And a lot of those companies, they get to kind of like a critical mass where you get not necessarily like max size, you get pretty fucking big. And then your really accelerated growth will slow down because you come to a natural constraint of sorts at some point. But smaller companies like this, they're way more agile. And it's actually very cool because that's what gives these companies, if they can survive the beginning, that's what gives these companies the ability to grow at the rate that they do. If we zoom out over the last 3 years, the company has gone from $3 to $87. That is a 2,200% return. If by comparison, I put up Northrop Grumman first, and I just pick an area that looks low, it's gone from 420 to 6, which is a 50% return. If I do the same with Lockheed Martin, and I pick a low spot here, it's gone from 400 to 551, 37%. This is the very neat thing about small companies that are able to gain a foothold and begin disrupting a space, which is actually quite fun. You love to see it. I love to see it. I think it's cool as shit. Man. I almost died. Carbonated beverage to the back of the throat is no joke. That got your boy good. Okay. Let's take a look at the options chain. Strong. Really big short put premium in S&P in general. And S&P is obviously rallying to highs, which is really good. That just bodes well for the broader market. And inside Rocket Lab also looks pretty strong. Really strong, actually, from some of this stuff back here. A little short out here. 15 Jan 27. Let's see what's up there. 15 Jan 27. The 135s? What are those transactions? They're not sure. What about the put? Oh, let me go back here. So this looks like the 115s and the 130s. So a lot of this is like short calls and stuff, which, yeah, I absolutely agree. BRB says, what's your view on institutional ownership? How much or how little do you look for in the context of something like Rocket Lab? So I don't necessarily trade any of this stuff from an excessively large long-term lens. But I would say in general, I realize I don't think this tool has like a total percent outstanding. Yeah, this just has like a number of holdings. Let me see if I can find that. But as you can tell, I don't even know what it is. It doesn't matter that much to me. No. What the fuck is it? Oh, one of these tools would have it. All right. Good old NASDAQ. 51%. I mean, that's good. That's a little high, but that's good. I would say in general, I think BRB says, was curious if it was something you paid attention to. Indirectly, for sure, indirectly. The reason why I say indirectly is you can literally tell how institutionally sponsored something is by its volatility. So a good example of that, something that has a lot of institutional sponsorship like LMT has 30% vol currently with an implied volatility percentile of 86%, which means that right now, relatively, its vol is super high. This immediately tells me that there's a lot of institutional sponsorship because the stock itself typically has lower vol. How do I tie that to institutional sponsorship? Because it's less of the actual float moving on a daily basis. So if a bunch of the float is locked into pensions, hedge funds that are just holding it, it's not going to move that much, or comparatively as much as something with less of that. So in general, I would pretty much say that volatility itself is a really good proxy for institutional ownership, because things that are really, really volatile, typically speaking, are going to have average lower institutional sponsorship, and it's because there's more available to move more readily, and you'll see that reflected in the market. So yeah, it is something that I do indirectly pay attention to in that way, but I literally just use volatility as a proxy for it. It doesn't matter, for example, like if this is 51% or 42%, like those numbers, they don't mean that much to me. But as soon as you start getting like 65% plus, it's going to slow down, and it's going to continue to slow down from something that was, 20% that goes to 30, 40 and so on. Its overall volatility will come down. Yeah. All right, gang. That's it for me tonight. If you guys need anything, hit me up in the Discord, be an outlier. See y'all later.